Hello, everyone. It's Evan here from the Trade Risk on Friday, November 24th, day after Thanksgiving, holiday shortened week. Hope everyone had a wonderful holiday break away from markets to eat a lot of food and spend time with friends and family. I just finished some Thanksgiving leftovers, so I'm going to try and keep this short before I fall asleep on this video. And we're going to kick it off here with a brief version of our usual stock market weekly video. Before we get into the charts, two reminders, of course. Trade Risk's Black Friday sale is live right now. In fact, it ends on Monday. So all week long, we've been doing up to 40% off all trading systems, all of our Warden TC2000 stock scans, indicators, and layouts, and also our trading tools, our TR150 watch list, and our position size calculator. Shop the sale. The link is in the description below. These prices will go away on Monday. We don't do sales at all, really often, I should say, but it's mostly once a year. So take advantage of it while it's here. And our sponsor of the show, so let's give a shout out to them, Investors Business Daily. Everybody knows their name, of course. They are also running Black Friday sales. They are a sponsor of the show. They help make the show possible. So I've got a link in the description to get access to a 50% off their digital subscription, stock scanner, trade ideas, IBD 50 list, editorial content, lots of stuff packed into one membership. Pretty inexpensive, get you access all year long. Link is in the description. So thanks for Investors Business Daily sponsoring the show. You can support us, support them with a link in the description. So let's get into it here with charts. Again, it was a light volume 3.5 day trading week here for markets. This is the weekly chart. We're just going to look at a handful of charts today, but S&P 500. So this is the fourth straight up week in a row now. You can see over these past 4 weeks, volume is basically steadily on the decline. That does kind of track for this time of year, just generally speaking. But the S&P has covered an impressive 11%, a little over 11% in these 4 weeks. And these levels, as frequent viewers know, have been on the charts for quite some time. But these horizontal areas of sort of inflection, these big round, mostly round number levels that market seems to care about. It's not us saying these are important. It's the market's prior price history telling us that these levels are important. But you can see that the S&P 500 is making its way to the top end of this resistance, the old cycle highs that we hit in July. So that's right around that 4,600 zone. I believe that was kind of said last video update, kind of saying the belief here was that S&P is going to make its way up to sort of test this area and see how markets, see how traders react to 4,600 on the second time around. I still seem to believe that would be the case. Now it's a much easier call because, well, we're only 1% away. Frankly, that could happen on Monday. So S&P, bulls in control here. It's full-on chase mode at this point, as we've been talking about. So these levels that we mentioned in our last few videos, we talked about the urgency behind gaps, and what open gaps really tell us as traders is urgency. It's pent-up demand. It's a rush into markets. When these gaps do not get filled and you get stacked gaps one after another, that tells you of either, however you want to think about it. Urgency is how I just said it, but it could be positioning that's offsides. However you want to think about really just the momentum stacking up. And you can see we've got our third open gap here where the market basically gapped open. The lows of the day was the open, and then it drove higher throughout the session. We've got our third one here, and S&P clearly in this full-on chase mode. Take a look at all of these green bars that have stacked in here over the last 4 weeks. So really nothing has changed in terms of direction, in terms of momentum, in terms of kind of positioning here. It's this melt up mode, and eventually that will change. Eventually we're going to get an imbalance and markets will pull back and maybe come back and fill some of these gaps. It's just not yet. It's not now, and right now we continue to grind higher here. So S&P 500 seems like it's on its way to 4,600. If we take a look at the Nasdaq 100, it is now starting to clear above its July highs. In fact, it did it this week. You can see the July highs for the Qs were around 386. Markets punched through them on Monday of this week, and then they sort of just danced, kind of hovered around in this range into the end of the week here. But we did get above sort of new cycle highs made. If we have to now zoom out even further to get to the old prior all-time highs, which were in 2021, and you can see that's up here around 405. We talked about them last video as well. Seems like Qs probably want to get back up there and test that area. It's 3.5% away, so that one's got a little more distance, not certainty by any stretch at this point, but seems to be a magnet up here for Qs. Again, the chase, the momentum, the gaps, everything applies here for the Qs. For you short-term traders that want to tactically sort of manage risk, well, look at these July highs. If we cut through this, if we see a high volume reversal, if we see a big kind of expansion bar lower below 386, that would change my tune. That would get me a little more, perhaps at least neutral on the market if we came kind of, pushing with urgency back below 386. But until and if that happens, got to respect the trend, the chase, the momentum to the upside. Last but not least, let's look at the Russell 2000 here. Has been lagging, but it is more constructive, a lot more constructive now. We've got this series of kind of higher highs, right? Higher high here, and lower high. Higher lows. I can't speak today. It must be all this turkey. Higher lows, higher highs. That's a good thing. That's a good thing if you're long markets. You can see we've got this in kind of, in place here. And it looks like, especially with this little kind of pent up angled momentum, we got sideways right around this 180 or so. Looks like it's ready to punch through this next week. And this is a good thing. Remember, this all hinges. This is the Russell 2000. These are the smaller cap stocks. These are the things that really just haven't been working this year. And so this is, again, a good sort of basic metric on breadth, market breadth, as we track that. If you're seeing the Russell 2000 going up, that is a good sign that market breadth is improving, liquidity is improving, and so keep an eye on this. This is important. This is going to be certainly something that could help extend this market rally to get small caps and some of these, just breadth expansion, generally speaking, into play. So that is the quick and dirty recap there on the major markets. I want to talk about a couple of things that is important. Here is the VIX. The VIX index closing at, I'm going to adjust my chart here, 12.46. This is basically a 4-year low for the VIX, going all the way back to January of 2020, so almost 2019. We haven't seen the VIX close down here below 12.5. So this is impressive. Again, markets aren't at all-time highs here, but certainly the VIX is at let's face it, 2019, 2020 lows. If you look at the S&P 500 up at there, and again, this isn't the perfect example proxy, but we peaked out here for the S&P in late 2021. So we're seeing really kind of fear come out of this market at rapid pace into the year end here. And perhaps this is what's, helping justify this new uptrend that kicked off a few weeks ago in stocks. So VIX under 12.5, nice to see. Lowest close in almost 4 years. Impressive stat there. We also saw healthcare coming alive this week. Again, short week, but 2.25% leading the charge this week. It was on light volume, and it's not really breaking out of anything. XLV has been largely sideways here for the better half of 3 or so years. So we're just mostly kind of pushing back up into the middle of the range, playing some catch up, but still notable that we were, kind of seeing outperformance here on a relative basis this week. And I'll leave you with one commodity observation here is natural gas. Poor natural gas bulls just can't catch a break here. This range has been developing all year long, just about, and it's starting to now test and probe and hit new cycle lows here for natural gas. It's below $6 for the UNG ETF, and kind of at the bottom end of this range, or again, marginally making new lows here. So what we always like to say as folks are looking at breakdowns of this range, it is definitely the path of least resistance. Just don't sleep on a quick and sudden violent reversal, right? And look no further than the Russell 2000. About 3-4 weeks ago, we talked about this as it started to make new marginal lows as the last buyers kind of got washed out here. We talked about the fact that this, oftentimes markets like to sort of do that quick head fake and then kind of rip in the other direction. And natural gas, just could very well be that type of similar setup. No bags attached to it, don't have a position or anything like that, just keeping an open mind. So natural gas certainly seeing more weakness here, even as the dollar is weak, but keep an open mind on that trade. So that is it. That is what I'm going to keep things at, short and tight this week. I hope everybody had, again, a little bit of a restful week and some time away from markets. Don't forget, in the description of this video, we've got IBD, we've got Trade Risk, our own Black Friday sales running. Check them out below. Have a great weekend out there. Don't spend too much money on Black Friday, and hopefully everybody's staying warm, eating good, and having some good time this holiday season. Thanks so much. We'll see you back here next Friday. Take care.